Dan, what are you expecting from the jobs data?
Well, consensus is 2.8 versus 2.9 last month. I can't say we're wildly different from that. I guess there is a slight concern for another unpleasant surprise, if you will, from the markets. One, perhaps because they've taken their eyes off the ball, given all the other things that we've had to talk about over the last week. The risk, though, is if you look at inflation expectations in the U.S., they've actually been coming back down. So if we did get a surprise on the upside, higher wage growth, given what's been happening with inflation expectations, I think you do have a chance for another bump in equity prices, but certainly nothing like we saw a month ago.
Michael, I've got a chart, but it's not nominal wages as you showed. It's inflation-adjusted wages. Michael, you know this chart better than me. This is the Atlanta Fed wage chart adjusted for inflation. And Mike, as you know, the headline here is "It ain't happening." And we hear that from all our viewers, all our listeners. Where's the wage growth, Mike? I don't see it out there. Where is it?
Well, Tom, go back a little bit to, in your graph there, to just after the financial crisis when wages went way down. They went way back up again. And there is a feeling out there among economists that perhaps what happened is companies held on to their workers and didn't cut their pay, which is what you would expect under a normal economic model to clear the system. And so wages have remained sticky. They've remained higher than they otherwise would have been. Now, you tell that to the guy who looks at his paycheck, and he doesn't think so because he wasn't expecting it to be cut in the first place. But that may be one reason. Also, companies get used to keeping costs down on the employee side. Sooner or later, they've got to raise wages if they can't find workers.